Okay, hello everybody. Today's Sunday, and so about 2 weeks ago, I asked ChatGPT, can you create a picture about debt payoff Sunday style, right? All money is credit. Put all of your money into a line of credit if you're paying off debt. Thou shall not save money. And this is really cool. The donation box that's connected to a futuristic tube called Your Lock Deposit. I don't know where this goes, but I think that'd be really cool. And then I asked ChatGPT, if I go to a typical church today, what percentage of people do you think are in debt and broke? And then ChatGPT says, probably about 30 to 40%, or I don't know if it's 30, 40%. Yeah, 20 to 25 to 40% are financially strained. So think about this. I know a lot of people want to donate more money to the church, right? But if you have no debt, it's much easier, right? I mean, I guess you have to ask yourself, which institution do you want to give money to, the bank or the church? And I think a lot of people would prefer to give to the church than the bank because the common sentiment is that banks are not so good institutions. Okay. All right. Anyways, let's go ahead and get started with debt payoff. What's the lesson of the day? It's thou shall not save money, right? And that's what we're going to do today. We're not going to save money using something called the velocity method. So we used to call it velocity banking, but the state of Illinois said, can't do that, right? So the state is getting into the churches, the velocity banking churches affairs, apparently. All right, so let's go ahead and get started. Yeah, so what's the first step? It's basically creating our budget because your budget is your debt attack plan, right? And then you have your leftover checking and savings. And then you see right here, we have three credit cards, an auto loan, a mortgage, and then our personal expenses not tied to that 1800. So this is just going to be a very simple situation, or relatively simple, because we're always dealing with 10 to 20 debts every time we do a demo. And then anytime I say 3 to 5, I was like, that's just too easy, right? So what's this velocity method? Well, basically, it's just not saving money 2.0, not saving, whoopsie, I screwed up. Let me go back here. Okay. So not saving money remarketed, right? Not saving money 2.0, and then this is going to be zero right here. And I know for a lot of people, right? A lot of people, this is really scary to not save money because we've been taught, like, hey, you need to pay off debt, but at the same time, you need to save money, right? But what if we did something crazy, which is put all of our money into debt? And a lot of people are scared to do that because they think when they repay the debt that the money is gone, right? People even think about this with credit cards. Now, what we're going to do is use something called a line of credit to dump all our money into debt. And what's a line of credit? It's basically a financial tool where you can borrow money, pay it back, and use it over and over again. Now, a credit card is a form of line of credit, but we're going to use a personal or home equity line of credit. And why do we use those? It's because when we put the entire $5,000, okay, into, let's say, a line of credit, we can easily pull that money back. Whereas if we put the $5,000 into a credit card, we can't easily pull that money back, right? If you do a cash advance on a credit card, you get charged with like fees and all that, and it gets a little bit messy, okay? And I think the bank thinks you're desperate. This is what I heard. I don't know this for sure. The bank thinks you're desperate if you take out cash advances. So why not get a cheaper tool that is specifically for advancing cash, right? That's what a line of credit is. And so what we're going to do is move some debts into the line of credit. We're going to rank which debts to move using something called the cash flow index. And basically what we do is take the debt amount divided by the monthly payment. And then here, this is 8,000 divided by 260, right? And then we do that for all the debts. And then basically we get a ranking system, right? So the lower the number, that's the one we want to pay off first because low numbers mean we get more bang for our buck, and high numbers means we get little bang for our buck, right? So think about this: in order to get $1,100 or $1,200 of cash flow back, I have to pay someone 250,000. Whereas, how much is this? Let me combine all this and sum them up and get the cash flow. That's about ooh, excuse me, $922.50, right? So $922.50 of cash flow for just these three credit cards, which is I think about 28,000, right? 28,000. Okay, so now let's go ahead. and move this 28,000 into a line of credit and assume we have a free and clear $30,000 home equity line of credit. Now, will the bank give you a free and clear home equity line of credit when you don't have that much money left over and you've got a lot of debt, right? And in this instance, I don't know, maybe because you got a home and it's not like you're $10 left over, you're a couple hundred, but it's still a lot of debt to income, right? So it's probably they're probably going to deny you. And why will they? What's the ultimate rule when it comes to banking? Is that banks don't lend money to people who need it because people who need money, according to the bank, are very bad people, right? They are very bad people. So banks don't lend money to people who need it. So if you go to the bank and then you need money and then they'll look at you and laugh you out of the room, right? So we demonstrate with the free and clear line of credit just because it's easy to see the benefits of having a line of credit doing the strategy. And usually when people come to me, they already have like one or two lines of credit that are just maxed out because they don't understand that you got to use your line of credit as your main operating account, meaning you dump your entire paycheck in, take your expenses out, right? So let me just kind of do this here, and then we're gonna move. We already moved that 28,000, and so when we move that 28,000, this literally goes to $688 to 1611.15. I don't even know why I'm saying that. $1,611.15. And then so we see here, okay, um, we're going to put this entire 5,000 into the line of credit, take our expenses out, and then rinse and repeat over and over again. So let's just go ahead and do that. And I'm going to just do this, okay, minus 161.15. And then what we're going to do is take the average daily balance. I'm going to go ahead and do that right here. Multiply it by the interest rate and then divide by 12, right? And then why do we multiply the interest rate by 12? Is because interest rates are quoted annually, but you really pay monthly, okay? And then so I'm going to go ahead and do this. And I'm going to go ahead and copy and paste this. And then we see that in month 19, right, those credit cards are paid off, okay? So 19 months. And then this is going to be 28K. And then I'm going to copy and paste this. And then now we have three more or two more, which is the auto loan and the mortgage. Okay, so let me just, I think I'll just wipe this one out for now. And so what month are we at? We are month 19. Okay, so let me just do this. 1919. And then we just follow the cash flow index model again. So we could just move this 15 grand auto payment into the line of credit. Okay, and I'm going to go ahead and copy and paste this. And then this is going to be plus 15386.52. And then we're going to increase our cash flow by $395. So now our cash flow is about 2 grand, right? Don't you love simple situations? I might just do like three or four debts going forward because every time I do a little bit more, it takes me 20 minutes, although right now it's like we're at the 8-minute mark. All right, so now what we do is we go here, so minus 2006.46, and then I'm going to go ahead and copy and paste. And then we see that in 27 months, so still under the 3-year mark, we paid off the car now. And I'm just going to do this, 27 months, and then this is going to be 28 plus 22, so that should be 50, right? So that's going to be 50. So 50K, okay. All right, so now at 27 months, so it's going to be 27. What's the current balance of the mortgage is $239,000. Now, a lot of people might say, well, should I move this whole loan into a line of credit? And the answer to that is probably not. Because we see this, we have this 4% loan, right? If we move this 4% 30-year mortgage, aka high cash flow index number, into an 8% line of credit, you get very big loan, little cash flow. So moving a very big loan with low interest or lower interest to same big loan with higher interest and little cash flow added um, as a benefit means you'll just end up paying more interest, right? So really there's two ways that we can do it. Number one is that we just put this as an extra payment, okay? Nothing wrong with that. But the issue is that this is the default and nobody does it. And why does nobody do it is because overpaying a loan and sometimes even a credit card adds friction to your entire banking process, right? You ever have moments where you overpaid a loan and you're like, "Uh-oh, another bill's due and I don't have a way to get cash out." And then you're a couple days late because you have to wait for the next paycheck. Happens to a lot of people, right? Happens to a lot of people. So another way that you can do it is use a line of credit, kind of what I call as a bridge, right, to help you overpay the loan and make it easy. Doesn't mean that, the first option doesn't work. I guess this is a question of which one are you likely to execute and keep doing, right? Because what happens is that most people don't have the willpower to overpay loans. And the reason why they can't overpay loans is because they have to constantly think every month, how much should I overpay? Right? Whereas if you do something called sweeping, which is you take a piece of the loan and move it into a line of credit, okay? And all you have to do is making sure that your checking account goes to zero and your line of credit eventually goes to zero, which makes it much easier, which means no thinking, and no thinking means you're much more likely to do the strategy. I don't know if you knew that or not, but yes. So let's do this. Let's go ahead and just move 5,000. Okay, I'm going to move 5,000 of the mortgage into the line of credit. So it should probably take us about yeah, 2 months to pay off, right? So you see it took us 2 months to pay off, and then we just kind of do it again, and then it took us, oh, let me see here, right? About 3 months, 1, 2, 3, and then we do it again, over and over again, just like before. I think that's a Linkin Park song. And yeah, so now you basically do it over again, and then that's one way. Another way you can kill the principal. Now, the way that I like to think about this is kind of like middleware. I don't know if you ever heard the term middleware and software, but so for example, let's say you have one website like Salesforce that wants to talk to another website like QuickBooks, right? Or two different web software systems like Google Sheets versus who knows what, some other popular website. But what I'm saying is there's a huge market out there for, let's say, middlewares, um, and companies will pay a lot of money for it, right? And you kind of think of the line of credit as a middleware. So why like not directly connect one system with another, right? That's because when you're dealing with many, many systems and many, many debts, it becomes unscalable. Now, if this is your last debt, yeah, it's not that big of an issue. But what I'm saying is that the line of credit helps basically become your central hub for your finances throughout the entirety of your debt payoff journey. And if you're just saying like, hey, with this one loan, I can directly pay extra payments, I want to focus on it, that's perfectly fine. Most people won't. Okay. Now, I have this calculator here. Well, all I got to do is just type in the numbers. And let me just kind of do this. These are updated numbers. So what's our monthly income? It is $5,000. And the expenses, 1,800. Okay. And then what's the current balance of the loan? Let's just do this. Well, I'll do 5,000. Wait a minute. Is the income 5,000? Yeah, income's 5,000. Okay, so now what's the current balance of the loan, which is 239,841.08. 239,841.08. Okay, so now you see that the mortgage gets paid off a little bit over 7 years, 7.4 years. And if you want to see like some differences, obviously, so here's the thing. If you move this entire $200,000 loan into a line of credit, look at how much interest you pay, like 98 grand versus 38 grand. Okay? So I don't think 5 to 6,000 will make a difference, but I think you're going to end up paying a little bit more, right? Wait a minute. Let me go back. Actually, you end up paying a couple cents less. 12. This was 28 cents to 12, so I think it's okay to increase it to 6,000. But I don't know like my rule of thumb is just kind of like if this is your last debt, maybe two to three times the cash flow, you should be fine. So 5,000. But anyways, my point is this, right? 7.4 years. That's the debt payoff, and even using a 30% line of credit is going to be better than doing an 8% moving the entire mortgage into a line of credit, because you have to not just think about the interest rate, you have to think about time and volume. right? Time and volume. That's really what you have to think about. So this is just another way, right? And actually, this calculator is the reason why I never really became super afraid of high interest rates with paying off loans, right? Like, oh, use a 8% line of credit, pay a 3% loan. That's the dumbest decision ever. And you're like, oh, it's not really that significant. And I might even pay a little extra to help create that bridge, just like a lot of the companies pay a lot of money for the middleware, right? The middleware is what connects is your financial hub that connects all of your debts to the centralized tool, which is AKA the line of credit. All right, so now let me just go back here, which is 7.4 years. So now I'm just going to do 0, and then it's going to be 27 divided by 12 plus, what is it? It is 7.4 plus 7.4. 9.65 years debt free. Okay. All right, so now it's $3,200 of cash flow, and then we're all good. And yeah, that's pretty much it. So happy Sunday, folks. If you went to church, did you tithe? I know that Caleb Hammer has videos about people tithing and then they're still broke. So yeah, maybe we might do a review of that because it's Sunday. But yeah, I think if everybody is debt free, much easier to donate to the church. In fact, I know one church where they never even asked for money, so I don't even know how they survived. Like it's kind of weird. Like, you got the building to pay for, AC, maybe some staff members. So if you ain't asking anybody for money, you probably have some huge donors, or you're probably broke. Okay, not a joke, but I don't like to think too much about it. Okay, well then, have a great day, everybody. It's Lanta Mentorship, and let's see if I can crank out a few more videos today.